is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. I am Alex Tapscott here with Andrew Young. Andrew, last week we talked about this crypto meme known as Uptober. This is one of those things that has no real basis in reality, but if enough people believe in it, it can actually cause a self-fulfilling prophecy of prices going up. It is true that in the past, October has been one of the better months for crypto, but other months have also been good and other months have been worse. And honestly, when you're looking at a data set of like 15 total years or less of performance, like you can't really draw any conclusions, but people are anyway. So we talked a little bit about that meme and also what are the upcoming catalysts that are going to shape the next sort of 3 months of market activity. And we did say that Uptober or Upfall or whatever you want to call it was still very much in play. And we talked about a number of different catalysts. When we had that conversation, the price of Bitcoin was around 60,000. Today, as we recorded, it's around $67,000. So things have gone up quite a lot in the last little while. Some of the big catalysts that we talked about, things like the election being a big catalyst, or the FTX liquidation and repayment to creditors being a big catalyst, those things haven't actually changed at all in the last week. So I'd like to talk about what has changed and if this recent move in the markets is the start of something that we've anticipated, or maybe it's a flash in the pan because these catalysts are still not playing out in quite the same way we thought they would. So let's start with the state of the election. I mean, we are in the last couple of weeks here, 3 weeks before Americans go to the polls to choose their next president. People have been talking about an October surprise. Have we got anything in the last week? Let's talk about it.
Yeah, I think there's a couple different things I think that's going on. One is like you said, there's been a very market regulatory shift in favor of crypto. I know you want to talk a little bit about the Kamala pivot, so I'll leave that to you. But there's been a couple developments. I think one, Trump has moved pretty decisively in the last week from a 50-50 sort of favorite or like a 52% favorite to, I think as of today, he's almost 59% favorite.
And that's when you say that, like, what are you talking about? Is that the polls or is that the prediction?
That's just based on the betting odds across
based on betting odds. Okay.
Most of the betting sites, yeah. Most of the betting sites now have him like a 58.5% favorite. It's gone up pretty dramatically in the last week after a number of polls showed him leading, particularly in the battleground states. I think he's now leading in 6 of the 7 battleground states, which is pretty crazy given that, this time in October 4 years ago, Biden was up 7% across the battleground states, and Hillary was up 6.5%. And obviously, he won the 2016 election, and 2020 was effectively a nail biter. So the fact that he's now leading outright, if you have any polling miss that was like the last 2 elections, then it will essentially be a landslide. Let alone just if the polls are just correct, then it looks like he would edge it out. So I think the betting markets are sort of reflecting that. And then on top of that, also, Kamala's come out with some like what I would term as half-hearted attempts at sort of placating the crypto crowd. I'm not sure if that's the right way to characterize it, but that's kind of how I think me and most of the people in the crypto industry see it. I don't know. Do you have a different take on that? I guess before we keep going, but.
Well, I would say that I don't think crypto is a big priority of Harris and the Harris campaign. I don't think that it's because they secretly harbor all sorts of ill will towards the industry, or that they've got big plans for how to punish it or something like that. I just don't think they haven't cared really. If you look at Harris's background, she's a California politician. She's cozy with a lot of California VCs, Silicon Valley VCs, and in general, her rhetoric around innovation has actually been pretty enlightened. And so I don't think that she's out to get AI, crypto, or any other sort of emerging technology. But what I will say is that I think until recently she's been kind of indifferent, and I think that is starting to change. And the reason it's starting to change is because of politics. I'd like to think that she's having a belated realization that blockchain technology and Web3 is strategic to the future of America, and that the financial innovation that it will enable is going to help to make the country a better and more profitable and prosperous place. I don't think she's there yet, but she does realize that actually a lot of voters do care about this. And there's a couple of really interesting through lines to this data. Through line number one is that actually a lot of Americans own crypto assets. And a lot of Americans in battleground states who own crypto assets have said that it's one of their top election issues. So there are many people who are considering how a candidate approaches this technology and asset class in their decision on who to vote for. And in some cases, they may even be single issue voters. It's probably a pretty small part of the population, but certainly anyone who works in the industry or has a large financial interest in the asset class is likelier to be in that camp. So that's number one. Number two is that despite the cliche, unfairly earned, that crypto is the domain of tech bros, working in Silicon Valley and Dubai and Miami and these places, actually the data tells a very different story, which is that you're more likely to own crypto assets if you're a person of color, if you're someone who's lower income, if you're a recent immigrant. And there are probably a lot of reasons for that someone who's more knowledgeable about it should untangle. But one of them is clearly that for a lot of people, being underbanked, creates more room for them to use this technology to solve problems in their lives as a way to invest money, as a way to move money, to repatriate at home, to family living abroad, as a way to get access to other forms of financial services. And I think that that's something that maybe the Harris campaign is belatedly trying to wrap their heads around. For what it's worth, something you and I have been talking about for a long time. In fact, I've written about it pretty extensively in Web3, my most recent book, and previous elements of our newsletter. We've talked a lot about how this is an issue that should be bipartisan because it affects everybody and because it's used by everybody in more or less equal measure. And if anything, more by people who would typically fall into, the Democratic base of support versus, say, the Republican base of support. So I would say that the efforts so far have been half-hearted, to your point, but they're a half heart's better than no heart. And I think that from a market perspective, what does it mean? Well, what it means is pretty much things are going to improve, no matter what, no matter who gets elected when it comes to crypto policy. I think people who've listened to this podcast long enough know my politics, but I will put those aside and say, I actually think that a Harris presidency would be great for crypto and could be great for the economy and for innovation overall. And I think that what's happened because of people who own the asset class, by those in the industry who have been advocating for this to be an issue and for educating politicians, there's a lot of great organizations out there doing good work. That collective effort has shifted the Overton window completely on this issue, where now we can have I hope, a normal conversation, disagree on some facts and interpretations of those facts and so forth, but basically have a conversation where we're moving towards policy that will be good for the industry. And, maybe I'm being Pollyannish, maybe people think I'm being naive about that, but the worst case scenario is off the table. So is that why the price has gone from $60,000 to $67,000 since we last recorded the podcast? Who's to say? But I certainly don't think it's her.
Yeah. I mean, I think it's definitely, I don't know, I would say it's partly people are seeing the regulatory winds shifting more favorably. I would say it's definitely a big piece. At least that's kind of what a lot of people are sort of attributing it to. I don't think it's a coincidence that, Bitcoin's been doing quite well over the last week at the same time that Trump's odds have been shifting favorably. And then on top of that, you obviously Trump officially launched his World Liberty token, which I don't know what it does. It seems to be some sort of DeFi wrapper project, but it's still kind of crazy to have potentially the next president has his own DeFi project with his own token. That's pretty insane if you were to think about it. So I think that's partly one aspect. I don't know. I think partly crypto is just sort of again. I don't who knows what's going to happen over the next 2 to 3 months, but I do think sentiment is relatively low in crypto. So potentially some of this sort of increase in price is just essentially just a technical rebound. We're we're not technical analysts on this pod, but it does seem like things are sort of due for a rebound in sentiment, just given given all these different catalysts we're constantly talking about on this podcast, and just like how low sentiment is.
Yeah.
I mean, I don't know. What else do you think it is? Like, what do you have any other? I know you were talking a little bit about Bitcoin options as well before. Do you think it's something to do with kind of like leverage, or there's not? From what I last checked, there's not that much leverage in the system right now.
No, there isn't. I mean, I haven't looked at the data in a couple of weeks, but the last time I checked, Bitcoin on exchange, ETH on exchange was hovering near an all-time low, and that is usually a sign that long-term holders, including ETFs for that matter, are taking those assets off exchange, parking them in either cold storage or in these new investment trust vehicles, in these ETF vehicles. And that means that if there is ever any retail buying of the underlying asset, that there's less available supply in the short term to go around. So that's always an interesting data point. The other thing that's interesting is that in Q1 of next year, most likely we're going to get options on ETFs. So there already are options on crypto assets, but there are going to be options on the funds themselves. Why is that important? Well, what it does is it creates more ways for different kinds of investors to own these products. So I'll give you an example. People on this who listen to the show might be familiar with the idea of a covered call strategy, where basically you buy an asset and then you write a call at a price that is above the spot price of that asset. What that means basically is that by writing the call, by selling the call, you're earning a premium. So you're earning effectively like a yield. And so long as the asset trades between the price that the strike price and then the price of the option, you're able to earn that entire return. If it goes above that price, then you are forced to deliver shares on the call option, but you can do that by delivering the share that you own. I hope that was a good explanation. But basically the idea is that now you can have Bitcoin with yield, right? Like, someone can package this up, like a fund manager can package it up and say, come buy our, enhanced yield Bitcoin ETF. It's got Bitcoin, and we do this covered call strategy where you're earning this yield. And what does that do? Well, it reduces the volatility of owning, or can reduce the volatility of owning the asset. So that's going to attract a whole bunch of new people to invest in the asset class. Covered call strategies are incredibly popular across many different kinds of asset classes. But to do it, you've got to write the call and buy the underlying. So every time you do one of these things, you're buying the underlying asset, and buying pressure is going to put pressure on the price. So that's a very simple explanation. But basically, the idea is by creating options, you are creating more excuses to buy the asset. You're also creating reasons to sell it for other reasons, for doing other kinds of trades. And that might contribute to volatility. But overall, what it does is actually, in general, increases the total set of potential investors and types of products that you can apply to this asset class. So that's known as covered call strategy. And it's something that I think, on the whole, is going to increase demand. We've seen this play out before, by the way, in Canada. We've had options on ETFs here, and that's led to these types of products that have gathered quite a lot of money. So in the US, obviously, things happen on a much larger scale. So I think that people are gearing up for that potential outcome and the impact that it may have on the price. And then the other thing that we've talked a little bit about is the FTX, the not executor. I use that word because it's like a will for a dead person, but it's the receiver. So the receiver in this bankruptcy put forth this plan, which is approved by a court, to basically return all this money to people who were creditors, aka users of the platform. They're all going to receive $1.18 on every dollar that they had on platform in fiat. So, maybe Solana was like 90 and now it's at 150. And so they're missing out on some theoretical upside by not getting it back in crypto. But the fact that everyone's getting $1.18 on every dollar is a pretty good outcome for a bankruptcy. I don't think, I'm not aware of, typically what happens is in a bankruptcy, certain creditors might get made whole. Most creditors get some money back. Equity holders almost always get wiped out. Now, if it's a bank and the bank goes under, there's the federal deposit insurance for depositors, and depositors of that bank are treated more fairly than others. But this wasn't a bank. This was some offshore Bahamian crypto asset exchange. So the fact that it played out this way exactly, where the users are going to be made whole plus, I think is an incredibly positive outcome given the circumstances. And we've talked about, like, what are these people going to do with the money? Well, look, I don't know about you, but everyone who I knew who was an FTX user wasn't their like first kick at the can. Like, they had accounts with Coinbase and they were, trading on DEXs and they were doing lots of other stuff. Like, it was a pretty crypto native group of people, which is all to say, I think that a lot of the money that these individuals get back is going to get recycled into the industry. It's not going to end up, parked in a bank account, a GIC, or, whatever. It's high yield savings account. It's probably going to get redeployed. And I think that that's like an obvious incremental buying pressure that's going to help contribute to the asset flows. And then the final thing is just these ETFs are just beastly. They're gargantuan. They've gathered 20 billion of assets this year. On Monday to October 14th, which was just earlier this week, they gathered $500 million in a day. US dollars, greenbacks. I mean, it's just a staggering amount of demand, which is not coming from crypto natives, because if those people wanted to own it, they could own it on exchanges or store it themselves. It's coming from new types of investors. So anyway, the more I talk about this, the more bullish I'm getting, because there's all this stuff that's kind of going on right now and is still downstream from where we are. And I think that's pretty exciting.
Yeah, no, I totally agree. I mean, I think it's one of those things too that it's like, I would say everyone's sort of expecting crypto to rally, but no one kind of believes that it will. So like, I think it's one of those things where, most people who've been in the crypto industry for multiple cycles, which, it's both of us. I think I've been around for 2.5 cycles, and you've been around for maybe 3 full cycles.
Yeah, 3 full ones.
Yeah, this is like one of those things where it seems incredibly obvious that I should be deploying a ton of capital, as much capital as I have, possible, into crypto. Just, it really feels like classic inflection point before kind of the, insane 12-month melt up that we saw in 2013, 2017, and 2021. Obviously, that's only sample size of 3, so
yeah,
hard to really bank a lot on that. But it's actually very similar to, I think it was maybe end of 2020, very similar, actually pretty much very similar time frame as now. Like right on the heels of a 2020 election. And I remember just talking in my group chat with everyone, being like, this just seems like the most obvious thing in the world, that crypto is going to go crazy in the next 12 months.
It will be hilarious in a way if it actually plays out that way. Like, if it's just really that simple, and it just like, this is just what happens. Like, what kind of world is this? If that's true, and like people don't believe it, it's like literally like the biggest alpha blob of all time that just sort of sits there, where it's like, yeah, at a certain time every 3 years, you just like buy the market, and then something happens and it goes to the moon. It's like, how is that possible, Andrew? How can that truly be? Like, it doesn't. And to your point, it's like everyone thinks it's going to happen, but nobody thinks it's going to happen. Everyone
thinks it's going to. Everyone logically is pretty much, everyone has the same time frame too. Like, everyone in crypto right now thinks the next 12 to 18 months is going to be crazy. They should be deploying as much as they can. But it just feels wrong, and it's also one of the things I've learned about crypto is that it has to be the most reflexive asset I've ever seen, in the sense that when the asset class is going up, it sort of justifies a higher valuation because it's got a lower cost of capital. There's all the numbers go way up in terms of adoption, TVL, and then as well as like just revenues also go up. In terms of like transaction fees and things like that. So it is kind of one of those things where when things are hot, it sort of justifies the price. And it kind of lulls you into this trap. I think like one of the things I'm really focused on with this crypto cycle is I think like I've done a good job of buying crypto over the years, but I've done a very poor job of selling crypto over the years. And so I think like one thing a lot of people, and I would guess like a lot of people have the same sort of same issue, or maybe they sold some crypto, but then they redeployed it at the top of the last bull market and ended up losing it all or ended up doing poorly. I think one of the things that people do a really poor job of in crypto generally, and probably just financial markets more broadly, is actually setting and sort of adhering to set sort of sell prices. Like you're never really going to sell the top, but I think with crypto particularly, the fundamentals look so good at the top of the market that you can kind of justify a higher and higher price, and so I think like one thing that a lot of people, listeners of our show or just crypto investors generally would benefit from would be actually setting like pre-setting like exit prices for a lot of the crypto assets that they hold, and then having some sort of a way of sticking to them, because if you're like me and you think crypto is about to go into a crazy bull run over the next 12 to 18 months, the worst case scenario is just buying a bunch of crypto during the next 12 months and then just sitting on it and going through the inevitable 80-90% correction that seems to also happen every 4 years. So I think like definitely something that you can do is just literally create a spreadsheet of different prices at which you would exit out. And it could just be, it doesn't have to all be, at this price I sell 100% of my Bitcoin or Ethereum. It could be like a scaled exit plan. So, at like $8,000 ETH, I'm selling 5%. At $8,500 ETH, I'm selling another 5%. I think that's kind of the ultimate, probably the most basic way of actually taking profits out. Obviously, the key is to not then take the profits from selling Bitcoin and redeploying it into some crazy vaporware AI project at a $10 billion valuation at the top of the market, like actually taking that out into cash. Just because I think that's like the one thing that no one does a good job of. And from what I can tell, no one, the reason why I kind of like the preset sale prices is that it's kind of like it's essentially like an objective criteria that you just follow, and it sort of takes the guesswork out of it, because inevitably
Right.
it's going to be pretty much impossible for, well, again, saying this very generally, but from talking to different people in crypto, it's very common. I would say it's the norm for people to sort of bag hold through the entire market cycle, as in like buying crypto as it rises and then holding it as it falls, just because it's easy to get caught up in the excitement, even if you're just a fundamentally driven investor like we consider ourselves.
So what's interesting about the whole discussion is that it sort of assumes that the asset class is commodity-like and trades in this reflexive way. And it doesn't account for changing fundamentals and why you may want to own something for a long run. So what's interesting is that Benjamin Graham, the father of deep value investing, like Warren Buffett, Charlie Munger would say that this guy was their inspiration. His point of view is that the market price of an asset is almost irrelevant, and things would almost be better if there wasn't a market price, because as an investor, you're not owning something because of the price per se. You're owning it because it's a good business and it's going to generate value long term. So that's a blah, blah, blah way of basically saying like, hodl, what the Bitcoin folks say, which is, listen, markets, you can never time this stuff correctly. Markets go up and down, but in the long run, if you believe that this asset class and the technology is going to be more widely used, that certain large platforms are in the lead and unlikely to lose that lead, like Bitcoin, then don't mess around. Just own it and hold it. Maybe that's useful advice. Maybe it isn't. But one thing I will say is that every single cycle, the fundamentals change. And sometimes it's narrative driven, where there's a new thing that everyone's really excited about and they glob onto that. And other times it's not a new thing, it's an old thing that comes back. So this time around, what I'm really interested in is Ethereum, Solana, and these other assets. So Bitcoin is basically in spitting distance from an all-time high right now, like as we speak. Its all-time high was like 74, 73, like it hit 68 today. It's at 66 and a half, whatever. But like that's in crypto land, that's chicken scratch, right? Like we're basically there. But Ethereum's nowhere near its all-time high. And Solana, which everyone's talking about is, narrative shift and Solana's taking over, it's actually nowhere near its all-time high. And so I wonder about these other assets, right? Like if you look at the market today, where's a lot of innovation happening? Where's a lot of experimentation, new application development, and so forth? It's still happening on platforms like Ethereum. Solana has also picked up some steam, and some others are coming in, and there's L2s and all the rest of it. But like, where does the market leave thif other assets? Like, let me give you three scenarios. ETH A fails to hit its previous all-time high in this cycle. B, ETH hits its all-time high from the last cycle, plus or minus 25%, right? Like, so it goes to like 5K or something. C, there's a scenario where ETH goes to like $10,000 or more. Like, how would you risk weight these three scenarios? Because there were lots of assets from prior cycles that did really well that never reached their all-time high the next time around. And there are others that did. So I'd love to just understand how your thesis applies to the market at an individual asset level. Because obviously, will the market capitalization hit an all-time high this next cycle? Well, if we think it's all going to go up, then yeah. But what happens to these individual assets?
Yeah, it's a good question. I think a lot of people, if you follow, Chris Bernanke, who's like one of the top crypto hedge fund managers,
yeah,
his target for this cycle is $10 trillion. I think the current crypto market cap is about 2.5. So he sort of sees like an overall 4x in the market cap.
Yeah, that seems like about right, I guess.
Yeah, I mean, again, based on past cycles, it seems somewhat reasonable. It's tough to know, really. I mean, the question then becomes, do you think Ethereum and Bitcoin, do you think your specific crypto asset will maintain its current percentage of total crypto market cap? Will it increase its relative percentage of crypto market cap when crypto is at $10 trillion, maintain or decrease? I would probably guess that Bitcoin and Ethereum will probably see maybe like slight decreases in their dominance or, essentially their market cap over the total crypto market cap. Typically what we see in bull markets is, Bitcoin, Ethereum, they sort of maintain and or fall relative. And then you see like a whole, and part of the reason why is because there's just a flood of new assets and new supply hitting the market, which increases total crypto market cap. I think it's something like a couple $100 million of unlocks hit the market every day just from all these different layer ones and things like that. I think there's going to be a couple big narratives that hit the market. So the first narrative, I think, is going to be the rise of what I call alternative layer twos. So right now there's a ton of, there's hundreds of different layer twos built on top of Ethereum. They're pretty much all EVM compatible. I think we're going to start to see different types of sort of virtual machine layer twos hit the market. So an obvious one is like SVM. So that's like the Solana virtual machine, which is being pioneered by Eclipse. Yeah. I think we're going to see some, for example, I think we're also going to see some like movement-based chains hit the market and start to grow. Move-based chains, which again is a different sort of programming language. So we're going to see, I think Solana is going to have some of its own first layer twos as well. They call them network extensions, but it's essentially the same thing. So I think we'll see a big rise of like alternative layer twos, and we'll see a lot of growth there. And that sort of includes things like, I would sort of include Berachain in that group as well, though it's more of an EVM based, but it has.
So is Berachain related to Solana?
No, it's actually built using the Cosmos SDK, but it's EVM compatible. Its innovation isn't more on sort of its like virtual machine build. It's more on how it's got this thing called proof of liquidity built in directly. So it's essentially like a chain built for DeFi, particularly like lending and perps. So I think we'll see like the rise. Yeah, I think like one narrative is the rise of alternative layer twos. I think another thing that we'll see is the rise of Solana killers. So if the narrative last market was like the rise of Ethereum killers, I think we'll see the rise of Solana killers in this market. You're starting to see that a little bit with Sui. I don't even know how to say it. Yeah. SUI.
Chop Suey?
Sui.
Yeah.
Chop Suey.
Chop Suey. I remember.
Yeah, it's gone crazy. I think it's up to like 25 or 30% of Solana's market cap now. And it's just, and I haven't really seen that much fundamental growth there yet, but at least people are sort of speculating on it being a Solana killer. I would say like that's probably one narrative, another narrative to look out for. And then I think like the final sort of narrative is just like is just what I'd call like the super high beta crazy stuff, and that's going to be probably a split of meme coins. Meme coins are probably going to be like this cycle's version of NFTs. I think we'll see we'll see some craziness in like the decentralized AI space. We really need to get an episode going on that, just because I think that's like, it doesn't really seem like there's that much substance there yet, but it's definitely something that I think will be huge, just given the success of NVIDIA and OpenAI and how much demand there is for sort of AI-based investments. And then I think we'll see a lot of stuff in the DePIN area as well. There's a little bit more substance there. We had the Hive Mapper CEO on. I think there's some, it would be great to get like the Helium CEO on or someone from their team. Because I think that's also a really interesting space. I think like that's kind of like, those are kind of like the three narratives I'm sort of watching for. I guess to answer your question, I think Ethereum doesn't really fit into any of those narratives. I think Ethereum is going to be priced kind of like Bitcoin this cycle, where it's essentially just like a blue chip that, kind of like a low beta blue chip that does well when the market does poorly, and probably underperforms when the market does well. So I could see a lot of people are probably going to sell out of ETH and buy like high beta stuff if you're someone like me who believes the crypto market's going to go up significantly, because I think ETH and Bitcoin will probably underperform in the bull market, just like as they historically have. The corollary is it also won't go to zero when the market inevitably turns. Historically, what we see during these market cycles is Bitcoin and Ethereum do relatively poorly at the start. I should say they do really well at the very start. Then they do very poorly throughout most of the bull market, because people rotate out of like low beta stuff into super high beta things. And then at the very end, they start to do really well as people start to rotate back out into ETH and Bitcoin. So I think that's part of that sort of also kind of explains some of the dynamics we're seeing, where, after doing quite well over the last 12 months, Bitcoin and Ethereum have been doing, they've been doing okay, but nothing compared to like what meme coins have been doing, and things like Solana have been doing over the last 6 months. So if I was to guess, I would say like we're sort of in the first or second inning of that middle portion. So anyways, I don't know if that really answers your question. I guess from a markets dynamic, probably what will happen is Bitcoin and Ethereum, and maybe to a certain extent Solana, will sort of underperform. And then when they start to do really well near the end of the cycle, that's typically like a warning sign to get to that things are about to turn.
Yeah. Well, we'll see. I mean, I'm personally wondering whether or not there's been a vibe shift and there's going to be pretty muted growth maybe, or very little growth actually in some of these large cap names in terms of market cap. But I'm probably overthinking it. And I think that previous cycles have had a way of playing out, and there's no reason to think it won't be different this time. Which is to say that typically Bitcoin leads, then you see a wealth effect into slightly smaller names. Ethereum followed last time, and then from there, as the market gets extended, you start to see growth in assets that are narrative driven. Could be meme coins this time. I hope that's not the only thing that's exciting, because I think that's a pretty unsustainable platform on which to build a marketplace. But we'll see. One piece of commentary I saw, I can't remember who said it on Twitter, was basically that meme coins are attracting dollars and eyeballs. And so if you're building a project with, quote, great fundamentals, then the fundamentals need to be really strong, because it's even more competitive than it used to be. And so maybe what that will lead to is that, if there is a DeFi renaissance here, or if there is this Solana layer 2 thesis, or whatever it is that plays out, that the projects will be even much more legit. Counterpoint, maybe they will adopt many of the same techniques as the meme coin world, and we'll end up with things that are indistinguishable from meme coins. I don't know. We'll see. But it's going to be interesting, that's for sure. Well, listen, that's a pretty good way to wrap it up, I think, because this is a conversation that doesn't really have an end point. We're going to keep talking about all these different issues. And we're back next week with a couple of great guests, too. So please tune in and make sure to like the podcast, share your thoughts, leave a review, post on social media. Helps others find the show and helps with our search algorithm. Until next week, that's it for DeFi Decoded. I'm Alex Tapscott with Andrew Young. We will see you next time. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.